Justin and I have been, as Ali mentioned, Justin and I have been actively investing for many decades. And, we're not just, we love to learn about the market. So we're not just teachers, and Justin hosts podcasts, which we really enjoy. We're also students. We're always learning. We're always looking at the latest research to improve. And we're also, fortunately, like Justin with his podcast, gets to speak with some of the smartest investors in the world. So we are teachers, we are active investors, we have experience, and we're also students, and we love sharing our knowledge. So what we hope to come out with this is not just give you the fundamentals of the stock market, but also give you practical guide so that you can hopefully improve your investing philosophy and become more successful long-term investors. So we're going to talk about three big ideas. The first idea is, first, why invest in stocks? And if you're all thinking about this, right, first thing that comes to mind is we want to invest in stocks to make a lot of money. And that's a simple answer. And what we're going to do with this is kind of show you some tools to help you accomplish this in the safest way possible and avoid a lot of the pitfalls and mistakes that I know I've made when I was younger and that a lot of individual investors still make. Justin's going to take you into passive investing and discuss the use of ETFs, which is a great tool to help you maximize passive investing in a very, again, safe, simple way. And he's going to give you some great insight into that. And then at the end, I'm going to take you into some active investing strategies for those of you that want to actually beat the market and make as high a return as possible. I'm going to talk about that and give you some ideas and also some of the mistakes that I've made in the past and how to avoid them. All right, so first of all, why invest in stocks? All right, we all know we want to make a lot of money, and the data proves this. So if you look at this chart here, and look at starting at the bottom, inflation has run a little under 3%. And by the way, this is a very long 96-year period. So the longer period we go back, basically the more robust the research, right? The more we can kind of rely on it. And so inflation's run on average about 3%. Right now it's running, it just recently dropped to about 4%. We had it up at 6%, but in the long run, it's been a little under 3%. And so the idea is to make as much money as possible above the rate of inflation so that your real value grows. And if you invested very safely like treasury bills, you barely beat inflation. So over this 96-year period with treasury bills earning 3.2%, you would have made about 22 times your money, a little bit more than the 17 times that inflation has cost you. If you start taking more risk and going out, you start getting higher returns like treasury, government bonds, 5%. But the real reason to invest in stocks is because the compound average return in the long run is much, much higher. If you invest in large stocks, think of the S&P 500, over this long-term period, you've earned a little over 10%. So $1 would have turned into over $11,500 over this long period. And if you want to take even more risk and invest in smaller stocks with a compound rate of return of 11.8% a year, you would have returned an astounding, almost 50,000 times your money, for over 49,000 times your money. And, if you look at it, it kind of looks weird because you see large stocks, 10.1%, small stocks, 11.8%. Yet small stocks over this long period earned you more than 4 times what large stocks did. And that is due to the power of compounding. So when you invest, if you think about it, if you can earn 10%, a little over 10%, like in large cap, you will double your money every 7 years. There's a rule of 72 you can use to divide by the percent. So you would double your money every 7 years. If, on the other hand, you invested in bonds at 5%, you would double your money every 14 years. So after a 28-year period, you would have earned 16 times your money in stocks and only 4 times in bonds. So you can see how that compounding builds upon each other, just as a simple math little lesson, which I kind of show my students. And, this long-term growth is despite recessions, wars. We've had mini crashes, right? And the thing about I want to bring out too is that, well, this shows the average long-term return of the market. Most individual investors who invest in the stock market have not gotten nearly that return. Their returns have been much lower, more like 4 to 5%. And there's a lot of reasons for this, as we will get into. One of the main reasons is investors tend to panic and sell on the dips and end up rushing in to buy after the market's up. And I'm going to give you some really good strategies to avoid this. Next slide, Justin. And here's an example too, if you want to look at stocks versus gold and silver, you can see that stocks have significantly outperformed, almost any metal over the long term. Okay, it's not even close. And so again, stocks are a great investment. Stocks have also outperformed real estate significantly, and stocks are much more liquid than real estate. And real estate can be a good investment. I know those of you in Tyrone Home, involved in selling real estate, which is great. But stocks have got a much higher long-term compounding, and they're much more liquid. Next slide, please. Okay, now here's an example of what happened in 2020.
Got to tell you about it.
And this slide here is a big reason why a lot of individual investors underperform the market. Okay, now what happened in 2020 was very, very scary. We all remember, it's not that long ago, when COVID hit, people were really afraid. The whole economy shut down, and the stock market, the S&P 500, which is the largest stocks, lost over 34% of its value. And as an individual investor, when you're seeing your value go lower and lower and lower, it's really hard to stay the course. And so a lot of, when you start seeing this, a lot of people can't take it anymore and they sell. And, one of the advantages, by the way, of someone who manages your money or fund managers, not just to give you the right stocks to invest in, but also become like a behavioral psychologist. I know I got a lot of calls from friends and other people, some people who had managed their money, and they were panicking. And I said, look, just stay the course. And just be patient, right? Now, I had no idea when the market would turn. I'm not saying that I timed the bottom or anything like that. I just knew that when the market goes down a lot and you have a lot of panic, what it does is it sets up for longer term, for a longer run, higher return. And so in this case, a lot of people that sold the bottom not only sold at the low, but they missed the tremendous rally that followed. So what I recommend is that everyone should write this down, is a really simple, practical strategy to avoid this pitfall, is to do what I call dollar cost averaging. So if you take out a set amount of money out of your paycheck, money that you can afford, make sure. In other words, if you need money for your rent or some essential, okay, keep that money safe. But if you have excess, some money that's discretionary, and you put the same amount of money out of your paycheck into a 401k plan or something like that, what's going to happen is, when the market goes down, like it did in middle of March, say, of 2020, because stocks are cheaper and you're putting the same amount of money in, you end up buying more shares, right? And then when the stock market goes up a lot, you'll end up putting the same amount of money in, but buying less shares. That's dollar cost averaging. And it naturally is a way to kind of, the math works when you end up buying more when the market's down and buying less when the market's up. And that will increase your return. It also avoids all of these psychological effects when we have panic selling and other types of different types of biases that we have from the market. And next, we're going to look at some of the best performing days and what happens if you miss them. And again, this is another reason why individual investors that don't have a systematic strategy end up significantly underperforming the market. And now we're going to look at more recent times. This is the last 20 years, okay? Beginning of January 2003 till the end of 2022. So the S&P 500 during this period returned a little under 10%, 9.8%. And if you had put $10,000 in at the beginning of the time, you just left it in there, you would have been very happy. You would have made more than 6 times your money. You would have had $64,844, right? Great. But let's say you panicked. And if you remember the previous slide, if you had sold when the market was down and missed that tremendous run up. Sorry, Justin, go back to that previous slide 1 second. So I'm going to reiterate one point. There you go. So if you missed that little run up, right, you would have then missed out on a tremendous time. And so you could easily miss 5 or 10 days. Now go forward again. So the point is that if you just missed the 10 best days, like that rally, you would have only earned 5.6%. And instead of having more than 6 times your money, you would have had a little under 3 times your money. Okay, still not bad. You made money. Then if you missed the 20 best days, you would have had, again, almost half of that of a return, a little over 17,000, and so on and so forth. So it's very important to be consistent, to be disciplined, and try not to panic, and not to and not to try and time the market is very challenging. And so it's very important to take a long-term view for this.
Yeah, one of the other points here, just Andrew, is that investors feel losses hurt psychologically more than gains make an investor feel good. And so, if you're going to invest in the stock market, just sort of know your own personality and risk tolerance. If you're the type of person that's really conservative, and if you were to put I don't know, $50,000 in, and you're uncomfortable if that goes down to 45 or 40,000, that could happen at any given point in the market. So it's just sort of know that going in, that losses are scary, they're painful, and that, to Andrew's point, that's where these emotional, costly bad decisions oftentimes are made.
Great point. Yeah, it's almost like we need to protect ourselves from ourselves, right? Because if we've had trust in the market in the long run, we would have done very well. But if we start trying to outthink it and worry too much, we end up missing out on really good opportunities. So here's another reason to think about long term. So if you look in the short run, 1 year, right, the market, it's a little better than 50-50, but the market's gone down as much as 40% a year. It's gone up 47%, and it's very it's very variable in 1 year. So if you need the money, if you need cash a year from now, then certainly you wouldn't want to put too much money in the stock market. You want to be more liquid and have cash available, right? But the further out you go, the younger you are, the more time to retirement, the more the case comes to invest more in stocks. So even for a 5-year rolling period, right? We've had very few 5-year periods where the market's gone down a lot. Okay, the general trend is down 3% to up 28%. And then if you go to 10 years, on the worst 10-year period, you would have lost about 1%. Kind of like the 2000s were a lost decade, where if you invest the beginning of 2000 to the end of 2000 through 2009, you wouldn't have made any money. You wouldn't have lost, but you wouldn't have made money. And of course, with inflation, you would have had a real loss. But if you go further out in 20 years, the worst 20-year period, you would have still made about 6% in the market. So again, if you have this long-term horizon, if you have at least 20 years to retirement, there's no reason why you shouldn't be pretty heavily invested in the stock market, because the risk return is just so much better than so many other assets.
And by the way, those are annualized returns. So when Andrew says something like 6%, that means 6% annually over a 20-year period.
Correct. That's right. Right. So the return, right. And that's the worst. So in other words, over the worst 20-year period, you would have still earned an average of 6% per year. Okay. Now I just want to reiterate, that doesn't mean that just because the past happened, doesn't mean the next 20 years we won't suddenly lose money, be down 5 or 6%. It can happen, but the odds are pretty low. And it certainly hasn't happened in the last 95 to 100 years. So the odds are pretty good, assuming that you believe in the U.S. economy. This is U.S. stocks. And I just want to make an important point. When you invest in stocks, especially U.S. stocks, you're investing in the U.S. economy. So if you buy shares of Home Depot, you become a part owner to get a little bit of that residual income of Home Depot. So as Home Depot sells more product and grows their sales and makes more money, you get a little piece of that. You buy a little piece of Apple, you invest in. Apple makes all this money selling their iPhones and other products, you're getting a little piece of that. And the next thing we're going to go into being a passive, Justin's going to segue into passive investing and give you some tools where you can kind of get a broad perspective of this. But it's important to note that as long as the U.S. economy keeps growing, there's no guarantee, but assuming it doesn't change over the last 100 years, that in the long run, companies will make more money, higher profits, and stock prices will go up.
I think that's a great point, Andrew, because sometimes people, and I've had people say it to me, like investing in the stock market is like gambling. Well, it's not, because when you're buying stocks, and we'll talk about sort of some of these passive ETFs, something like the S&P 500, as a shareholder, you're buying and entitled into a piece of those profits. So to Andrew's point, as long as Home Depot and Apple and Pepsi and Bank of America and JP Morgan and those big companies are making profits and being profitable, which most of them are, then as a shareholder invested in them, you're entitled, you have equity in that company. And that's why, that's part of what drives the stock market return. So it's not like gambling in the market. There can be periods when investors go haywire, like the COVID chart that Andrew showed you. And those investors thought they were making a good decision by selling out. Obviously, they didn't. And that's where sort of the emotional, in the short run, it can be very volatile, but it's very different than gambling. Gambling is like random, the odds are against you. Investing in the stock market is like proven and the odds are in your favor over the long run.
Right. Let me just add one more point to that. So if you go to a casino and you play blackjack, roulette, or anything like that, the odds are against you. So the house makes money. The stock market, even if you consider it gambling, it's gambling with the odds in your favor, because if the S&P 500, the overall stock market in the US, averages 10% a year, you have an edge. So you're gambling with a positive expectation. And the other thing is, if you really need the money in the next 6 months, then it is gambling, because I have no idea whether the market's going to be up or down in the next 6 months, but I have a pretty good idea that over the next 20 years, if you invest in the stock market, you're going to have a decent return. And that's the big difference in perspective.
Yeah, so in this section, I'm going to walk you guys through passive investing. And passive investing is just simply buying into an investment strategy or a vehicle that looks to replicate a specific index or benchmark. So Andrew's going to talk about active investing in a few minutes, but passive investing is basically you're buying a basket of stocks. These basket of stocks are being selected using some underlying methodology. And there are different methodologies for different indices. But basically you're saying, by being a passive investor, I'm not looking to generate performance above and beyond the S&P 500 or the Dow Jones Industrial Average or the NASDAQ 100. I'm happy with getting those types of returns that the market or a specific benchmark is going to deliver over time. And as I just mentioned, the most popular ones are things like the S&P that invests in the 500 largest stocks in the US. The Dow Jones Industrial Average is probably the oldest index that invests in the 30 large cap stocks that they think the index committee thinks represents the US economy. You have the NASDAQ 100, which are the largest 100 stocks on the NASDAQ. Most of them are technology companies, as you would expect. And then the Russell 2000, which is a small cap index. And really over the years, there's been hundreds, if not thousands of indices that have been produced and that are out there. They don't all end up in sort of this ETF wrapper, which I'll talk about in a minute. But these are the more popular ones that you probably have heard of and maybe even are investing in. So looking at the S&P 500, using this as an example, here's sort of what goes into the S&P. You have very broad market representation and diversification. So you're investing in the 500 largest stocks on the US market. The index is what's called market cap weighted. So what that means is the larger stocks carry more weight in the S&P. So right now, technology names, things like Apple, Amazon, Microsoft, Google, Tesla's in there, they carry more weight in the index. So that can be good and it can be bad. Sometimes the index can become too heavy and too weighted in names that actually don't end up producing like really good performance. But generally over time, as Andrew pointed out, something like the S&P has given investors, a very, very long-term return of something like around 10%. It's just naturally diversified, even though you have some concentration in some cases when a handful of companies do really well, you're getting diversification across all different sectors and all different industries. As I mentioned, most of the companies are like what would be considered blue chip or high quality type companies. All of these indices, and it's just a portfolio or basket of stocks that we're talking about, there is rebalancings that happen. And what that means is on an annual basis, I don't know if it's annual or semi-annually, but the point is that the index will remove some names that don't meet the standards anymore of however that index is being constructed, and then new names will come in. So you get this natural almost management of the companies that aren't performing, they get moved out of the index and then new names come into the index. One of the things with ETFs, which the S&P 500, the ETF is, the ticker symbol is SPY. So if you had a brokerage account and want to buy SPY tomorrow at 9:30 when the market opens, you could just type that in and you could buy the ETF. The beautiful thing about ETFs is they're very transparent. So any ETF that you're interested in, whether it's SPY or anything else, you can always go and see like what's inside the ETF. The S&P 500, it's the largest 500 companies in the country. As you get more specific with some of these ETFs, which I'll give you some examples, you would want to look at the ETF and say, what is it holding? Am I getting the type of exposure I think I'm getting? And that transparency can be valuable for investors that want to look at that. And then things like the S&P 500 are used, it's like the major benchmark. So most active strategies, or many active strategies, I shouldn't say most, many active strategies benchmark to this. So it's like, does my active strategy outperform the S&P over time? Because if not, then the question is, why would I invest in anything else? If I can't find an active manager that has beaten the S&P, or at least I feel like has a strong potential to beat the S&P, then I can just buy the S&P and do it super cheaply. And this non-US exposure here, it's just a lot of these companies in the S&P 500 are global companies. So you're getting exposure outside of the US, Apple's business in China, or, Home Depot's international business as an example, you're getting that non-US exposure. So you are really getting like kind of a worldwide strategy when investing in something like the S&P 500. The other thing with something like the S&P, and this is true of most broadly diversified ETFs or indexes, is, and Andrew, you might want to chime in here because hopefully I explained this correctly, because it is a little bit, there's a skewness with stock returns, there's a skewness of returns. So you have, what this chart is showing you is from 1997 through 2017. So it's not all the way up to 2023, but the distribution of returns would look the same. Is you get a lot of companies actually produce returns below the average and below the median return in terms of the number of companies that are producing those returns. But because way over to the right, you have, even though it's a smaller frequency, but you have companies that are producing over 1,000. If you look way over here to the right, like the 1,000% returns, whatever, there's like 4% of all companies over this time period, over this sample, that have produced over 1,000% return. And so when you invest in an index, you're guaranteed something like the S&P, not all indices, but we're talking about the S&P 500 now. You're guaranteed that you're going to capture those returns of those companies that are way, way out there to the right. And the example that I have on this page is NVIDIA. So you may have heard of NVIDIA, you might not have, but since it's been adding to the S&P in 2001, this company, which is a chip manufacturer, which has kind of gone parabolic because of this whole AI thing, and its chips are used in all this artificial intelligence and processing and stuff. NVIDIA is up over 18,000% since it's been added to the S&P. So, many active managers don't have that, but in an index like the S&P 500, you're going to capture some of that NVIDIA return. Now, NVIDIA was a very small sliver of the S&P for a very long period of time, and now I think it's like one of the top 10 companies. So you get the benefit of this natural skewness that you're seeing in the data by investing in something like the S&P.
Yeah, that's great. I'll just add one thing. So one of the big allures of investing in stocks is what I call the positive asymmetry or skewness. In other words, if you bought a company like NVIDIA, let's say you put $1,000 into it. All right, the worst you can lose is $1,000, but you could have made, with $1,000, you could have made $1.8 million if you held it this whole time, 18,000%. So the point is, that's the allure, that if you're lucky, if you're an active manager and you pick NVIDIA and a few other stocks like Apple and Netflix, right, you could make a fortune. But if you miss these stocks, there's a lot of stocks that have lost money. See, if you think about it, and it's part of its hindsight bias, it seems easy because, just bought Netflix and Apple and NVIDIA and Amazon, right? You make a fortune. But those are the companies that have survived, that survivorship bias. Those are the ones we know about. For every NVIDIA, there's hundreds of companies that we don't hear of anymore because they're no longer around. So to Justin's point, when you buy a big index fund like an ETF, because you're getting a little piece of 500 different companies, and some ETFs you can get even more, you're guaranteed to get some of these companies that are going to make thousands of percent return, which could offset a lot of these companies that have lost money. So a lot of companies lose money, but the few that make a lot of money help offset a bit in the long run, if that makes sense.
Great. Yeah, thank you. So just a couple, I guess, things about ETFs that are attractive. And that includes this S&P 500 ETF we're talking about, but all the other ETFs have these type of characteristics. So they're liquid. That means you can trade in and out of them during the day. So if you bought SPY tomorrow and you want to sell it on Monday, you could do that. They're pretty cost efficient, especially the passive ETFs, what we're talking about here, things like SPY, the Russell 2000, you're getting them very, very cost effectively. And they're transparent, as we talked about. You can go to these ETF sites and see what's in the ETF and what it holds. They trade during the day, so you get this intraday pricing and trading, and then they're very tax efficient. And that's very valuable if you're investing with taxable money. And it's even more valuable if you kind of go from passive ETFs, and there are active ETFs. Not all ETFs are passive. There are active ETFs as well, but there's this natural tax efficiency that's embedded in them. So when stocks are moving within the basket, within the underlying portfolio, you're not paying any tax on that. If you were to go out and buy 10 stocks tomorrow and then buy the individual positions and then have gains on those in a taxable account and trade those, you would owe tax, either short-term or long-term gains on the gaining positions. Whereas when the trades are happening within an ETF, you don't have to worry about the taxes. You only pay the tax when you actually sell the underlying ETF. A little bit about the ETF landscape in the United States. So there's over 3,000 ETFs. There's almost $6 trillion, in assets that are invested in these types of vehicles. And then there's different types of ETFs. What we've been talking about are market cap or passive ETFs. So the S&P 500, the Russell 2000 as examples. You can also get sector exposure. So if, let's say, you want to buy financials, or you want to buy technology or consumer staples, there are ETFs to give you different sector exposures. Just in thinking, with the regional bank sort of blow up earlier in the spring, some people saw value in the financials there. So they were buying those financials. Other people that held the financial ETFs were like, I'm getting out of it because there's too much risk in some of these financial institutions. So that's, some of the, I guess, thesis on why, you might use those sector-based ETFs. Then there are things like thematic ETFs. So I have like agriculture, there's infrastructure, you have ETFs focused on artificial intelligence, you have this concept of ESG, environmental, social, and governance. So looking at companies that are doing things that are, I guess, positive or beneficial for the environment or social causes, or they have good governance. So, and there's tons of thematic ETFs that investors can choose from. And then the last category is active. So, can we buy a value ETF, or can we buy an ETF that looks to buy companies that have competitive moats around their business? So I just wanted to highlight the different really types of ETFs. If you're new to investing, I think you want to focus more over to the left. So it would be the market cap, the passive ETFs that we've been talking about tonight.
Yeah, let me add one thing to that as a quick, you could go to the next slide. It's fine. It doesn't matter. So one of the things, so I'm an active investor, but I'm a passive investor because it's so easy and tax efficient, as Justin mentioned. So one thing you could buy, like if you buy the SPY, the expense ratio of the SPY is 0.09%. So if you invest $100,000 in it, you only pay $90 a year, okay, which is a tiny amount relative, and you get exposure to all 500 companies. And you could buy or sell during the day. You could, anytime you want. Now, one thing I like better than SPY, okay, Justin and I are not allowed to give any specific stock advice, but ETFs, this is passive. There are other ETFs, like I'll give an example, like Vanguard, who's been the leader in ETFs. They have an ETF called VTI. And the reason I prefer VTI over SPY is two reasons. One, the expense ratio is even lower. The expense ratio is 0.0, a third of a tenth of a percent. So for every 100,000 you invest, you only pay $30 instead of $90. Again, not a big deal, but think about compounding long run, it's good. The second thing is, whereas SPY has, because companies like Apple and Microsoft and Nvidia have grown so much, it's become kind of a little more concentrated at the top with 500 stocks, whereas VTI has, I think, 3,500 stocks. So it's a little bit more diverse, a little bit more small stocks in with the big stocks. So just a little bit of a kind of a professional advice is look for an ETF that has even a lower expense ratio. It's going to move, it's going to perform about the same. So in the long run, you can hopefully compound a little bit better.
And before I hand it back over to Andrew, there, just some pros and cons. I mean, we've talked about some of this, but the pros are, most active strategies don't beat the market over time. So most investors would be better just buying something that's very low cost, like Andrew just outlined, and just being in the market and having market exposure. By buying an ETF, a passive ETF, you're minimizing the individual stock risk. It's pretty simple. And we talked about all the benefits that ETFs have to offer. I guess on the flip side of it, if you're looking to beat the market, then if you're buying something like the S&P 500, there's no potential to beat the market. There are strategies that can beat the market. They're hard to find, but even getting, 1, 2, 3% above the market over a 10 or 20 year period can be substantial in terms of the overall wealth and compounding that it can give you. I guess the S&P can be like the sector concentration issue. Like right now, there is a lot of technology in the S&P 500, but those are very good companies. So that's sometimes a positive, that's sometimes a negative. There's not a lot of small and mid cap exposure. So when you're thinking about your asset allocation, you would just be invested in large caps for the most part. It doesn't happen a lot, but like Andrew had mentioned before, there was a lost decade. I think there's been 2 decades in the last 100 years where something like the S&P didn't really generate or came very close to not generating a positive return for the market. And then there's no personalization with the S&P 500. You're just buying a basket of stocks. It's not really specific or built for you. And that's, to some extent, by the way, that's changing with technology, but maybe that's a whole nother conversation that we can have at some point down the road. Oh, and yeah, this is me, just this last one. I always like this chart because what this is showing you in this scatter plot is the S&P's annual returns going back to 1926. And as you can see, they're all over the place. I mean, up 40%, down 20%. I mean, there's more positive years than negative years, but the average return is 10.5%. But, it's very rare that the market gives you the average return. You're usually far above, or, you can be far below as well. And so that's just something to remember. Think about that in terms of stock returns. Is year by year, they're going to be very variable, but over the long run, they've rewarded investors with, as we've, pointed out with this information tonight. And then this kind of is also backing up one of Andrew's slides from earlier. This is the best and worst periods for the S&P 500 over different years. So in any given 1 year, the S&P, well, its best year was up 52.6%, the worst year down 43%. But the point is, as you go out longer in duration and longer time frame, the chances of losing money becomes less and less. And that's the important thing is investing, whether you're investing in the S&P, buying individual stocks or whatever, you want to take a long-term view, at least a 5-year, more like a 10 to 15-year view when investing in the market, because that is going to give you the best chance of generating positive returns over time. Andrew, back to you.
All right, so great. Thank you, Justin. So the first 2 things we talked about, why invest in the stock market, we've hopefully given you some good pointers for that. And with ETFs, it's a simple way to be a passive investor or somewhat active, but get instant diversification and have low tax liabilities and everything else. So right there, those 2 things is really all you need. But now, for some of you, like myself, okay, I want to beat the market. I don't want to just go with the market. And so, part of it is, I want to earn as high a return as possible. I'm competitive. And for me, it's fun. So actually, I really enjoy doing this and trying to beat the market. And so there's different ways of doing this. What I'm going to do is try to show you a strategy that I implement that takes away a lot of the biases out of it and gives you the best chance to be systematic and disciplined with it. So The first thing, of course, you want security selection. You want to pick stocks that have the best potential for what I call alpha or outperformance given the level of risk. Okay, that's why we want to be an active investor. Now, some people try market timing. I personally feel like market timing is almost impossible because, some people jumped in the market the last few days. The tech stocks got killed today. What's going to happen tomorrow? There's always these gurus that go on TV on CNBC or Bloomberg, and it's like flipping a coin. For me, market timing is more gambling than it is investing. All right, so I would try and avoid that. Now, portfolio management, position sizing is important. When you set up whether an active investing strategy, you want to do it so that you don't run the risk of blowing yourself up and losing everything. And so you want to have a certain amount of stocks that's optimal. You don't want to have too few stocks, because then if you pick a few wrong stocks, you can lose everything. But you don't want to have too many stocks either, because then you might as well just buy an ETF like the SPY or VTI, because it's going to be hard to beat the market. And position sizing. I'm personally a fan of equal weight instead of market cap weight. Now, in the long run, equal weight has outperformed market cap. In other words, equal weight will value a smaller stock in the portfolio just as much as a large cap. Although recently, large cap has outperformed. Certainly, if you look at the recent rally we've had from all these giant mega tech stocks, like NVIDIA and Apple and Tesla until today. Tesla got crushed today, but those stocks have done really well recently. But I'm thinking the long run, and in the long run, research shows that equal weight will outperform. And it's important to do your own research and analysis from this. All right, next slide, Justin.
Yep.
All right, so again, pros and cons. The big pro, and the reason we do it, we want to outperform. We want to beat the market, turn as much money as possible. But there are other reasons too. Flexibility and adaptability. For example, you might be, environmentally conscious. You might not want to invest in something that's going to hurt our environment. And that's becoming more popular. Maybe you don't want to invest in coal companies or gun manufacturers or, tobacco companies, or whatever it might be. So you could kind of filter it so that you avoid those kind of companies. All right. So you can kind of be customized to what you want. Right. Now, the cons of an active investment strategy is it's going to cost more. It's a lot more time involved. And if you hire a fund manager, you're going to have to pay them, a lot more than the 0.9s of a tenth of a percent from the SPY. Right. Generally about 1%. Try to have it 1% or less. There's going to be tracking error. And tracking error is the difference from the S&P 500. So you might set this strategy up, might be doing well, then maybe you go through a bad time and you see your friends all making a lot of money in their funds and your fund's not performing well. And that could be very psychologically taxing. And there's higher maintenance. Of course, I love this stuff, so I enjoy it. For me, it's not a problem, but you got to watch it and you've got to, or pay someone to do this for you. But the point is, there's definitely a lot of maintenance involved in here. And there's tax implications, because if you're actively trading, you're going to incur tax liability. If you sell a winner, especially a short-term capital gain within a year, you're going to have a higher tax gain on that you'll have to take into consideration. So let's now talk about what we feel are kind of the keys to building a successful active strategy. Okay, most important, whatever strategy you pick has to be conceptually sound. All right. And I'm going to give the example of value, the value metric, which we use in our strategy. Okay. Value makes sense for those of you in real estate, right? Just if you go to buy a house, if you're looking in the same neighborhood, there's about 10 houses with similar square footage. And let's say, each of these houses sold for $400,000. And you see another house there that for some reason selling for $350,000. Well, that's more likely to be a great buy. And you're going to get a higher return on your money in the long run, right? So it's conceptually the same thing for stocks. If you can find a stock that you pay less for, but get more earnings for, that's going to, in the long run, provide you with a higher likelihood of a better long-term return. And so the three features, the three things that I look for when I pick a factor, first, it must be robust. When I say robust, it must have, in the past, given a significantly higher return. In other words, stocks with good value have significantly outperformed stocks with poor value, right? Basically, cheaper stocks have outperformed expensive stocks. And that's one of the managers from Benjamin Graham, who was Warren Buffett's mentor. And Warren Buffett uses value. He also uses quality, but value is one of his factors. Okay, and then it must be pervasive. When I say pervasive, it doesn't just work in one specific market. It must work throughout different markets and even different asset classes. The value concept doesn't just work for stocks. It works for bonds. It works for real estate. It works for buying coins or artwork or anything else. And it's worked under different types of market conditions. It works in China. It's worked in Europe. It works in the United States. And persistent means that it works in the long term. Okay, if you look at it over the 96 years we showed you, again, stocks that are generally cheaper have outperformed stocks that are more expensive. So it meets all of these factors. And those are the kind of things, the type of stocks that in the long run, I want to invest in, along with other factors we'll get into. And this gives us what I call expected alpha generation. It means that by using these characteristics to select these type of stocks, there's no guarantee, but are more likely to get excess return above the market and beat the market. All right. The other thing to consider is risk management. You don't want to have your portfolio that you create too risky. You want to control the volatility so that you don't have too big of a drawdown. Drawdown is basically the downside of a portfolio. And it's very important to keep your volatility down. And here's the reason. Let's say you invest $100,000 in a strategy and you're excited about it. And it just so happens things go against you, you have a bad first year. And you lose 50%. You took a lot of risk, you lose 50% of the value. Well, now you're down to 50,000. And guess what? To get back to even, you now have to make 100% return just to get back the 50% you lost. So volatility and risk is the enemy of long-term returns. If you can keep it minimal, if you lost 10%, then you only need to make a little bit more than 10% to get back to even. So it's very important to keep your volatility reasonable. All right. And then transaction costs. It's important to pick stocks that are liquid, so your transaction costs are minimized. I know there was a question I'll get to later asked about penny stocks. Well, these penny small stocks generally have much higher transaction costs because they're illiquid. And that's also more like gambling, in my opinion. But I'll address that a little bit later. The other thing is to be implementable. Whatever factors you pick has to work in the real market. It has to be able to implement your strategy. You have to be able to use it to buy these type of value or quality stocks, or if you're a growth investor, growth stocks, whatever those attributes are. Okay, so these are the keys. And now let's talk about, you keep going, Justin, perfect. Now let's talk about an example of a strategy that we do called the systematic alpha. And we have a couple of different strategies, so I'm just going to go over the basic idea behind it. First is the number of stocks. We use 30 stocks, and we feel that's an optimal number of stocks because it gives us enough diversification. We make a mistake and pick a stock that gets crushed and goes down a lot, right? It's one of 30. It's not going to kill our portfolio. By the way, someone asked a question about liquidity. Let me explain that since I just saw it on there. Okay. Liquidity means the ease of buying and selling the stock. For example, a stock like Apple is incredibly liquid, or SPY is incredibly liquid because you could buy or sell a big position of it. You could put $1 million into Apple and you'll barely move the stock. It'll trade right around where it is. Where if you put even, I don't know, $10,000 into a little penny stock, if you want to buy it, who's going to sell it to you? You're going to push the price up. You'll end up getting a bad execution, paying more for it. And then, God forbid, you got to sell it. The joke is, who are you going to sell it to? The joke is someone bought a penny stock and up to $1, and then you say, all right, I made 100 times the money, I want to sell it. And the broker goes, sell it to whom? Who's the buyer? So it's kind of a joke, but that's the point of it. So we want stocks that we can easily trade and get in and out of. All right. Our tilt is value and quality because we feel that is gives us the best chance for long-term success. And I'll go over some of the specific factors we chose. I mentioned why I like equal weight better than market cap weight, keep the fees reasonable. And the big thing is the outperformance potential, okay? We have an expected alpha. We hope that in the long run, okay, I have no idea if it's going to outperform the next month or the next year, but over the long term, we have the odds in our favor that we're likely to beat the S&P 500. And we also make it somewhat tax efficient. What we do is, and through Justin, we have an algorithm where when we trade stocks, we're more likely to sell a losing stock so we can harvest the tax loss to give us tax benefit at the end of the year. And we're more likely to hold on to stocks that have gains, and especially hold them for at least a year for the long-term part. So we have algorithms that systematically we do this to try to keep our expected alpha while also being tax efficient. And we're going to have performance deviation, and we have a long-term orientation. Now let's get to the specifics of it. So here's an example of some of the overview of what we use. So you can see we're heavy in value factors. We use also sentiment factors. We look at what analysts are saying. We look at the target price forecast. We also look at short interest. I've done a lot of research and study into short interest and find that despite some of the short squeeze you've seen in GameStop, people that short stocks tend to be pretty savvy investors. And so we want to look for stocks that generally are not as short. We don't want stocks, we want to buy stocks that generally have less short interest. Okay, isn't it a quick example? We also look for stocks that aren't too volatile so that we reduce our risk of drawdowns, or if we get a bad situation like what happened in 2020 with COVID, we're likely to lose less in the market if we limit our volatility. And we want companies with a lot of free cash flow to what they owe, so they're more likely to be stable, okay? Now, the big thing, though, I want to talk about is I want to talk about some of the value factors, okay? One of the things we want to do is we want to buy stocks that are relatively cheap to other stocks. For example, if we were deciding whether to buy Home Depot or Lowe's, right? They're similar companies, the same industry, a lot of the same macroeconomic headwinds and tailwinds and everything else. But if somehow, I'm just making this up, if Lowe's was trading a lot cheaper for the cash flow or earnings or cash generation that it's getting, we'd be more likely to buy Lowe's instead of Home Depot as an example, or vice versa. So we look for stocks that are similar, and we then can pick ones that are better. Now, I'm going to talk about one of my favorite factors, which is free cash flow and enterprise value, and explain why that's a factor that I like better than some other value factors. And so, Justin, go to the next slide. So first of all, it's got to meet all those, it's got to make intuitive sense. So if you think about it, I want to buy or I want to invest in a company that's generating a lot of free cash flow. Free cash flow is less earnings, by the way. I want companies with high earnings, but earnings can be easily manipulated by different accounting. Think of Enron and some of the other firms that went out of business, even though they were showing good earnings, right? You could do a sharp accountant, could do a little depreciation here, a little amortization here, a little tax write-off here, and he can manipulate the earnings. So it's a little bit, now a sharp analyst could find this, but free cash flow is a little bit harder to manipulate, okay? It's the money left over after after the company has all the expenditures. And what we do is we compare it to enterprise value instead of price or market cap. Enterprise value also considers the amount of cash the company has, which makes it cheaper, and the amount of debt the company has, which makes it more expensive. So a company might look cheap on a P basis, but if it has a ton of debt, right? Sometimes companies borrow money to do buybacks and other things to make their earnings per share higher, so it makes them look better, okay? By looking at free cash flow enterprise value, we avoid that manipulation. So it's a more legitimate view of what the value of a company is. Plus, a lot of smart analysts use discounted cash flow models. They look at future free cash flow, okay? So I've just given a little bit of a long-winded rationale for the intuitive rationale of why, my conceptual reason why I like this factor better than most other factors. And then the other reason is the numbers bear it out, okay? I've looked at this over many, many years. When I was a trader market maker, I looked for companies with high free cash flow. And I'm just showing you over the last 15 years, it still works. If you're looking at it, let me just make this chart. I'll try to make it as simple as possible. So assuming you have, let's just take the S&P 500 because the math is easy. And let's say you split up the S&P 500 into 5 quintiles, right? Based on free cash flow to enterprise value. So you take the top quintile, the 20% of the companies, the 100 companies that have the highest free cash flow relative to what you pay for the free cash flow, all right? You put that in quintile 1. And then the quintile 2 is the next highest. Down to quintile 5. Quintile 5 can be the companies that have the worst amount of free cash flow, the least free cash flow, compared to what you pay for them. So those are the most expensive or least valuable companies in our model. And then we tested them. Every month we tested rebalance over this 15-year period. You can see there's a beautiful pattern where quintile 1 has a much higher return than quintile 5. Actually, quintile 1's monthly return of 1.14%, and it goes down at a monotonically, quintile 2, 1%, 3, 0.9%, and on down. This shows that this factor is robust, it works well. And if you look at it compared to a value index which combines things like P ratio, price to book, EV to EBITDA. Don't worry if you know these are value index. You can see free cash flow, in short, has significantly outperformed. So this would be a factor that I would use in my model because, again, it's robust, it's persistent, it's pervasive. So let's move on. Sorry for getting a little bit in the numbers. That's kind of, I get excited with this. But that's kind of, but by the way, before I give Justin's concluding thoughts, we don't just use free cash flow enterprise value. We use about 10 different factors to try to get the best of everything. And I'll just leave this with kind of a sports analogy. If you're putting together, say, an all-star team, let's say you're putting an all-star basketball team together, right? You don't just get 5 players who can only score, right? You want some players who can play defense, who could pass, who could rebound. You want a complete thing. And that's kind of what we do with building a portfolio. We want companies that are relatively cheap, but also have high quality, have good sentiment, have less risk, less volatility. So we put all that together to try to maximize our alpha. Okay, Justin?
So hopefully everyone has gotten some value from this. I'm sure we have all a very wide range of investors on this webinar tonight. But just sort of in concluding, these are kind of the big major points that I hope everyone will be able to take away from this, which is, over the long run, the stock market has provided robust long-term returns over long-term periods of time. But investing in the market and in stocks does come with some risks. There can be periods, whether it's 1, 3, 5 years, or maybe even longer, where depending on your entry point and depending on what happens, stocks could lose money, which is why you always have to take a very long-term disciplined view when investing in the market. As we talked about, passive investing aims to replicate the performance of major market indices, something like the S&P 500, and ETFs offer a great way to get that passive exposure. Active investing, as Andrew just outlined, offers the potential for outperformance. And if you're looking at an active strategy, I would say do as best you can, try to think about why the strategy has the potential for outperformance, and look at the numbers. And if you see something that looks too good to be true in investing, it oftentimes is. And so, there's no strategy that beats the market every year or every 3 years for that matter. Those really don't exist out there. And so just kind of be mindful. And if, you're presented with strategies, get feedback on it. Like ask around, does this look like a good investment strategy? Ask your peers. I mean, it seems like this is a very strong network of people that are on here tonight. So I would certainly encourage that. And then, I'm sort of, and Andrew kind of touched on this, like this hybrid approach is, if you are investing, I mean, maybe part of your investable assets are in passive, but you take a sliver of it and you say, you know what, I want to invest with this active manager or this active strategy to try to get a little more juice over the long term for my portfolio. That's certainly a reasonable way to think about it. And then just this last point, invest in what you understand and believe in, and hopefully with people that you trust. And so I think those are sort of to bookend the presentation before we get to questions. Those are, some concluding thoughts from our side. And I guess just in closing, as was mentioned, Ali mentioned it, and I appreciate it. I'm the co-host of the Excess Returns Investing podcast. My co-host and I sometimes talk with each other, but we're more so interviewing other investors out there, experts in their various fields. And it's something we're very passionate about. So you can find that on YouTube and all other audio podcast platforms. Andrew has a new book coming out soon, A Practical Guide to Trading, Investing, and Market Making. I don't know exactly be on Amazon, Andrew, or?
Yeah, it'll be out in about a few weeks, and I could put out a little blurb to Ali or TC, so I'll let them know.
Yeah. And then the only other thing is we do work with investors at Validia Capital and, help investors try to meet their goals. We run a number of investment strategies. And if anyone's interested in just talking to us about what we do here, you can just get in touch. My email, my phone number are at the bottom here. I'm always happy to have conversations with people that think they might need a little bit of help or just even have some general questions.